Good morning. Today is Thursday, March the 10th, coming on the heels of a very strong update yesterday where the market was up almost 3%, 2.68%. NASDAQ was up 3.5%. Oil fell significantly. But today we're giving some of that back. So market S&P 500 is down about 1%. Oil is up 4%. And I think that ultimately we'll look back to yesterday and say, hey, that was a little bit of a bear market rally. It could be a sign of things to come, but it was just one day, and one day does not a trend make. So market's giving back some of that today, but not all of it. So that's where we stand. Yesterday, we did get JOLTS job openings. December was upwardly revised to 11.4 million. January came in at 11.3 million job openings. And it was just a few months ago that we were talking about 10 million job openings, which is kind of an unprecedented, unheard of number. And now we're sitting at 11.3 million. So there's still a ton of job openings in this country, even while we have an unemployment rate less than 4%, and that we're only 1.5 million jobs below where we were pre-pandemic. So what we've been saying for the last 3 months or so, what we continue to say is that the American economy is strong. In fact, its demand in the American economy is more than the population can bear, the population can supply. There are more jobs in demand today than there were before the pandemic. The problem is you got to be able to fill those jobs, and there have been a lot of retirements. So we're still continuing to work through that. Job openings rate 7%. A hiring rate was similar to last month. The separations were down a little bit. What's interesting here, if you look at separations actually fell in construction. They're down to 4.1%. They were 4.6% this time last year. So, and that's a seasonally adjusted number. So construction starting to catch up to the labor issues. What's interesting though, however, is that on the finance and insurance side, you're seeing separations actually increase. That's up to 2.5% from just 2.1% last year. And you're seeing that especially in investment banks where people are hopping a lot from job to job as they kind of chase those signing bonuses. So that's where we stand on job openings. Still a lot of job openings, still a lot of demand for labor, and that continues to get reconciled by a combination of hiring and higher wages. This morning, and I'll hand this over to Tom here in a second, we do have the CPI, the inflation print, and it came in line with expectations, which are very high expectations. Headline print of 7.9%. Even if you exclude food and energy, we're still talking about 6.4% inflation. I'm going to look at some of the more details, but for now, I'm interested to see Tom's thoughts on whether or not this changes the Fed's calculus or even accelerates it. And are we looking at 2 rate hikes coming up next week?
Yeah, so it's interesting. Honestly, I was expecting a bigger number. I thought we would beat that 7.9. Though it should be noted that yesterday the estimate was 7.8. So they definitely moved it up in terms of matching the expectations. So month over month, we're up 0.8% versus the last month up 0.6. So we're accelerating into this month with in the inflation number. And year over year, we're 7.9. In terms of what the bond market's doing, all night long it was selling off. So right now it's not really doing much, but that's really because it has sold off so much in the last 24 hours that I think it may have actually oversold. So we're starting to see a little bit of green. The 10-year is actually falling a little bit. The 30-year is falling a little bit. The short end of the curve is essentially flat. So what we're actually seeing is a little bit of buying. And I think that was just such high expectations. Everyone was expecting a really big beat on CPI, and we're not seeing it. So for the moment, and obviously this could change, and a lot of times after we have these calls, it does change. For the moment, we're seeing buying in bonds, which, I mean, thank goodness, we're definitely seeing a little bit of demand. I mean, we are even down even more from yesterday's 10-year Treasury auction, which was kind of a dud. Rick Santelli gave it a C-, resident grader of Treasury auctions. Ben Nye also gave it a C-. But that was at a 191, and now we're at a 195 on the 10-year. So we've seen selling since then, though we're starting to see a little bit of strength this morning. In terms of the Fed, let's take a look at the futures here and see if it's affected at all. Yesterday, we were below the expectation of 1 hike for the 16th, and right now we are looking at 1.09 hikes. So we're skewing towards a double hike, but not enough to make me think that we're actually going to get it. My expectation is that on the 16th, we're going to get one hike. Towards the middle of the year, it looks like we're probably going to get a double hike somewhere in the June or September range, and a total number of hikes at 6 right now based on futures. So we have, we've been bouncing around in this range, but this has really been the more probabilistic outcome, which I think is one hike now, a double hike later, and probably 5 to 6 total for the year at the very most. So I wouldn't say a ton has changed. I don't think the Fed has a ton of tools they can really do to curb this, but I think the fact that COVID is unwinding, that oil prices are going up, I think that's going to be deflationary towards the second half of the year. So, we talked about it a little bit yesterday. I think today is going to be peak inflation. Knock on wood, that is my hope, that we'll start to see inflation on a little bit of a decelerating glide path towards the back end of the year. But for the moment, we're at the highest print I've ever seen in my lifetime. Which is not to say much because we mostly had zero inflation in my lifetime, but this is quite a number this morning.
Thanks, Tom. Yeah, as I'm looking through some of the constituents, we did see a little bit of a decline on the used cars and trucks, but it's still up 41% on a year-over-year basis. So that's still really influencing the headline number upward. We're also starting to see, and we talked about this at the macro presentation, we're starting to see that shelter increase. We're up to 4.7% on shelter, which again is the single largest constituent in the CPI print. So when your largest constituent's up 4.7%, you're going to have higher inflation. I think that's what we're seeing. And again, you could have seen this in the rent data. You could have seen this in the home sale data for a year. It just takes a long time for those survey data to fill in. And that's one of the reasons it is what it is. But again, they figure out the shelter piece of inflation by going to homeowners and saying, what could you rent your home for? And most homeowners probably don't necessarily have a great idea of that. And it happens on a lag. And so you're seeing that shelter inflation component come in on a lag. But we're still seeing not much cooling off in used cars and trucks. I expect more of that over the course of the year, but it's going to be slow progress. And as a result, I agree with Tom. I think that we're going to see some tapering of inflation over the balance of the year in line with what we said in January. But I think it's going to be slow, gradual progress. And this current oil reality does nothing to help that. Moving on to the ECB, the European Central Bank is meeting today. So European Central Bank meets today, and then the Federal Reserve for the United States meets next week. What's very interesting in this ECB print is that, and the press conference is ongoing right now, but it does seem like it's a fairly hawkish print. In fact, they're even talking about normalizing policy faster than previously anticipated. So Tom, talk us through that and what the reaction in the markets is happening right now.
Yeah, so we just got the notes and they're speaking now, but here's the main takeaways. The big one is that they're essentially they're turning the corner and becoming more hawkish. I think the writing's on the wall for Europe in terms of what they need to be doing. So these are the 5 bullet points that came out from the release, which is one is that ECB is going to end asset purchases sooner, potentially in the third quarter. So they're going to be essentially starting their taper probably right now. They're going to drop the pledge and purchases shortly before a rate hike, which essentially means they're going to hike probably immediately as they end their asset purchases. Next one, they're going to do whatever it takes to fulfill their mandate, which is similar to the Fed's mandate of maximum employment and limited duration. We've seen the prints come out from Germany, and they're in the 5 to 6% range, which for the European Union is excessive inflation, and so they need to do something to curb that as well. They dropped the wording that they could lower rates in the future. I think that's unlikely that they would do so, just given that they're turning towards a more hawkish stance. And the last one, bond yields rise on hawkish tone from stimulus. We've seen the 30-year Treasury or the Bund just go off like a rocket. I mean, the 10-year now is at 26 basis points. And the lowest it was in the past 3 months was negative 40 basis points. So it's moved significantly. It's now positive. Let's take a look at their 30-year as of this morning. Yeah, so their 30-year is now 44 basis points. It was negative 8 basis points very recently. So it's moved up significantly. It's now positive. So the negative rates we've seen, worldwide for developed non-U.S. countries seems to be coming to an end, at least as of this morning. Things obviously could change, but Germany has had negative rates for what feels like my entire career, and they're basically rocketing out of that on this news this morning. So I would expect worldwide rates to go up. This is going to put some pressure on the U.S. 30-year, which we talked about earlier, which is actually down today. But I think that that's probably not going to hold, given the fact that we're seeing just an upward movement, significant upward movement across the board in Europe. I mean, Italy's 30 years up 14 basis points today. Spain's up 8. Portugal's up 6. United Kingdom's all the way up to 166 on their 30-year. So we're definitely seeing pressure from the rest of the world pushing rates up, which hopefully will add some steepness to the U.S. yield curve and give us a little bit of a breathing room in terms of where the value is on the curve. Because right now the front end has just gotten absolutely hammered, and the long end has stayed pretty tight. But now we're seeing other places, other developed countries having pressure on their 30-year, which could definitely push us up.
I think, Tom, and I'd be interested to see if you agree with this, but and I need to listen to the press conference. I think the ECB is making a significant policy mistake with this. I think that what they're doing is they're trying to address inflation. So the ECB's mandate is a little bit different than the US mandate, which is maximum employment and price stability. The ECB's mandate is for price stability and sustainable growth. They define price stability as inflation less than 2%. There's a few nuances in that, but it's essentially the same as very close to the Federal Reserve. Where it's different is they also emphasize sustainable growth. We emphasize unemployment. So maximum employment. So it's broadly similar mandate. But I think that what the ECB is doing with this is essentially locking in stagflation, because I think that the ECB is essentially powerless to stop and prevent the inflation that they're seeing. They're not seeing the same demand impetus that we're seeing here in the United States. They're seeing the supply chain issues, but they can't really do anything about the supply chain. We're having a massive demand growth here in the United States. So they're not seeing that in Europe. And I think that this dichotomy, they're trying to respond and soften their economy in order to reduce inflation. But I don't think it's going to have any impact, because their gas prices are going up, their oil prices are going up, their electricity prices are going up, and all of their fertilizer prices are going up. So I don't think and Volkswagen can't produce vehicles, so their car prices are going up too. Bottom line is, I think the ECB is making a policy mistake by being too hawkish right now. And I think that you're essentially locking in stagflation in very dangerous times in Europe, which I think weirdly puts the US in a good spot. You got to be careful of Europe catching a cold and then giving it to us. So we got to be aware of that, and we'll make investment decisions accordingly. But I do think that this is a dangerous game for the ECB to be playing right now, and I wonder if they're making a policy mistake. Tom, thoughts?
Yeah, I would agree. I think Europe gets a lot of credit. I think a lot of Americans think of Europe as this very advanced place where, they're better than us and fancier than us. But in terms of their economics, they've had a very tough run of it, really it feels like the last 15 years or so. And there's a lot of factors there. It's a more diverse place. There's a lot of places with excessive taxation or extremely low birth rates, like Italy, Spain, Greece. There's a lot of factors there that we don't necessarily have here. We have lots of immigration. We have lots of innovation. We have the 401k system instead of the government pension system that I think really helps us in terms of economic growth. And Europe just doesn't have that. And they have not yet, like to your point, they haven't seen just the unbelievable numbers coming out of COVID that we have, because they didn't really have unbelievable numbers going in. It's tough to say exactly why they're doing this, but it's definitely not going to be good for them, particularly if you're, some of the lower end countries or the worse off economic countries, because if your rates start to go up, you're going to start being a real bad spot. It wasn't too long ago that Greece was essentially on the verge of bankruptcy, and they've been very beneficial. They benefited very much from negative interest rates in Germany because that dragged their interest rates down as well. But now that we're kind of getting into a normalization cycle, some of these smaller countries are going to be in a real tough spot. And I don't think that bodes well for growth long term.
We have to remember who Christine Lagarde is. She is not she's not an economist. She's not a monetary person. She is a bureaucrat, and she was head of the IMF. I think she was in the World Bank. And I don't think she's been late on providing more stimulus. And I think that she's being very early on this. She's saying that war is a substantial upside risk to inflation. And at the same time, she says that she's going to do whatever it takes to contain inflation and maintain price stability. I don't think those are compatible with one another. I don't think the ECB, if war is the inflation stimulant, the ECB is not going to reduce inflation, plain and simple. And so they're going to be pushing on a string. And I think that and the euro is actually rising on this, but I think that might be a short-term move, and it's beginning to fall again. So I would not be surprised to see continued euro weakness despite more hawkishness from the ECB. All right, moving on to Russia, Ukraine. Oil prices did fall yesterday after the UAE threatened to do an about face and cave to U.S. demands to pump more oil. The ambassador to the U.S. said that they'll be encouraging OPEC to consider higher production levels, but then the energy minister came out and said that UAE remains committed to the existing OPEC monthly output arrangement, and you're seeing oil prices rebound this morning. Foreign Minister of Russia, Sergei Lavrov, met with his counterpart Kuleba today in Turkey for about 90 minutes. Kuleba said that they're not going to surrender, and that's the condition that Lavrov wants. They made no progress on a ceasefire. Lavrov said that wasn't even on the discussion. Kuleba said that they want to join NATO, but understand that won't happen for the foreseeable future. Lavrov basically said, hey, we don't plan to attack any other countries. We could have a Putin-Zelensky summit at some point, but we need more preparation before that can happen. Ukraine's comments on neutrality caused, quote, certain optimism on the behalf of Lavrov. And Lavrov also saying that they want a friendly, demilitarized Ukraine. Ultimately, I think that this is a little bit of a nothing burger, unfortunately, for the markets. There was a lot that was hoped for this summit, but nothing really came of it. In addition, you have that terrible, horrific bombing of the Mariupol maternity hospital that Russia just completely denies, saying it was actually Ukraine radicals that did it, which of course is completely false. Zelensky asked for a no-fly zone to protect humanitarian corridors. Again, I think that's DOA from the United States perspective. Lukashenko, the Belarus leader, is meeting Putin on Friday. Ultimately, I don't think really anything came of this. Tom, any thoughts on this? It seems like it's unfortunately just going to continue to get worse.
Yeah, I think it's just a red herring. I think yesterday's optimism was a little early for sure. I mean, we basically saw an opposite day where everything was up except for defense and oil, whereas the last week or so, that's the only thing we've seen is oil and defense doing well. So my expectation is at least we're setting what seems like the groundwork for what the resolution could be. Is that it seems like there's some chatter that Zelensky is willing to be a demilitarized neutral state. They're willing to potentially not join NATO, but I don't think they're going to give up. And so I think there's riding that line. Is Russia going to be at a point where they're fine with withdrawing, letting Ukraine be demilitarized and maintaining their sovereignty and not being a puppet state, versus what I think they ultimately want, which is to take Ukraine over completely and make it part of Russia. But I think that's the chasm, right? If we can find some happy medium between the two, I think this thing will wrap up. But in the meantime, I think it's just going to drag on.
Market volatility certainly having an impact on some levered hedge funds and some asset managers, and Tom will like this, which is why we don't own funds, certainly in size. Araft Global Hedge Fund is shutting down. They were down 8.5% last year and down double digits this year. They bet big on companies like GitLab, which is down 53% year to date. Recall, being down 8.5% last year is not good considering the market was up almost 30%. So, he's had a tough time. But separately, probably a little bit more systematically, PIMCO, the PIMCO flagship fund that manages $140 billion in its income fund, it has been writing credit default swaps, which means basically it's been selling insurance on Russian debt to the tune of $1 billion, at least $1 billion. And they have a $1.5 billion of holdings in Russian sovereign debt. All of that could get wiped out, which would be a big hit for the flagship PIMCO fund. It's sized fairly appropriately. I mean, it's probably going to be maybe 2% of assets, but this is going to be a negative hit to PIMCO if they haven't got out of these hedges appropriately. Tom, any thoughts on this?
Yeah, I mean, we talk a lot about why we don't buy bond funds, and this is really a good example. PIMCO Total Return Fund, which at one point was the largest bond fund, largest mutual fund on the planet, consistently has run into trouble because when you get into a situation where you're in size and you have so many people invested in one fund, you can't beat the market unless you take some really big bets. And the only way you can take really big bets of enough size to move the needle in a bond fund like that is to do something like get into Russian sovereign CDS situations like we've seen here. And that's really not appropriate for clients, but the idea is, oh, well, it's just going to be, a little bit of the portfolio and it's spread across a million different people in their 401ks. But the problem is if you take a loss there, you take a massive hit like this, it affects everyone, it affects performance. And then what happens is people start moving out of your fund. Well, what does that mean? That means you got to sell bonds. Well, bonds are down, so you've got to sell into a down market, which loses value for everybody. And that's why we don't like to invest in bond funds, because you have zero control over, your interest rate risk, your credit risk, any weird trades like this that are going on in the portfolio. You either can't see them because they only post their holdings every quarter, or you don't know about them, but you think, oh, I've got a bond fund. This is the most boring investment on the planet. And they're just going to try and perform like the bond market. But in order to do so at that size, you got to take some risks. And that's what's happened here. And so this is why we like to buy individual bonds, because at the end of the day, we know what we have, what the cash flows are, where that money is concentrated, and we don't have to sell at any point if we don't need to, and we can just let bonds mature and reinvest when rates get higher. It's a more sustainable and predictable way of investing in bonds, even if it doesn't go our way. I mean, obviously the bond market's down this year, but we have control over those bonds. We're not forced to sell them. We can find opportunities for new bonds or for different ideas in a market like that, but we're not at all tied to anyone betting on the default of Russian debt or betting against it, for that matter, which is to our benefit, in my opinion.
Yeah, I mean, we're not in the business of collecting pennies in front of a steamroller, which PIMCO apparently is. So, so that's just something that we continue to watch, and we watch for the systemic impacts of that. Again, I don't expect this to be systemic, but again, this is why we don't do things like that. All right, Amazon, last story. Amazon approved a 20-to-1 stock split, $10 billion share repurchase program. It's the first stock split since 1999. It follows Alphabet's, Google's similar 20-to-1 move in February. Now, Alphabet's isn't going to take place in July. This one's going to take place at the end of May, beginning of June. This is good news for Amazon stockholders. I think it opens up a little bit more of an investor base, some people who can afford a $150 stock who may not have been able to afford a $2,800 stock. So I think that's good news. Stock is up 4%. Of course, this doesn't change anything to the fundamentals. It doesn't change anything to the value of the business, but it does open it up to a new investor base. And it does also allow for inclusion into the Dow Jones Industrial Average, because you need to be below a certain price, in effect, in practice, to be in the Dow Jones. Tom, final thoughts on either Amazon or any of these stories and what we're watching for the rest of the day?
Really, for the Amazon thing, I'm excited about it. It's one of the toughest things to buy for clients because it's such a big dollar price per share. And I think this makes us a little bit more nimble. I mean, for example, if you got $100,000, if you buy one share of Amazon, you're underweight. If you buy two shares, you're overweight. And so that makes it very difficult, particularly with smaller portfolios, to have the right amount of Amazon in the account, because you're either going to have too little or too much. With a lower dollar price, you can have 5 shares instead of having to buy 1 or 2. You can kind of thread that needle a little bit better, have the right amount of exposure, and not have to worry about being over leveraged. So I'm excited for it.
All right. Thanks, Tom. Thanks, everybody, for joining us and staying on for an extended show today. We'll be back tomorrow with more, and hope you have a great day out there. And we're going to get back at it. Thank you.